Hello everyone, welcome back to another week's video. Today I'm going over all the financial market updates from this last week, so July 17th to 23rd. It was a really eventful week. Starting off, here's the snapshot around the world of all the indexes and how they performed this last week. Green across the board, fantastic week. Starting off in the United States, we have the NASDAQ, which was up 3.3%, S&P, which was up 2.5%, and the Dow Jones, which was up 2%. The reason US stocks performed so well was number one, better than expected earnings and subscriber growth from some technology companies, and number two, strong consumer retail and discretionary spending, which is showing no signs of consumer slowdown, even despite all the inflationary pressures. Going over to the UK, the FTSE 100, their main index, was up over 1.5%. This was largely due to optimism being returned to their markets at the beginning of earnings season, as well as some strong economic outlook from some British banks. Going over to Asia, in China, there was a 1.3% increase in the Shanghai Composite. This is also due to renewed optimism ahead of all the tech earnings, specifically Chinese big tech, as well as this other piece of news which happened over the weekend, which is that the SSE, or the Shanghai Stock Exchange, which is Chinese equivalent of the SEC, vowed over the weekend to maintain market stability, saying that it will resolutely prevent big and swift changes in capital markets. They announced they'll do so through reformation of the IPO process and accepting political responsibility of preventing and resolving financial risks. So this is great news for the Asian markets and will most likely continue to bring the Chinese indexes even higher over the coming weeks. In Japan, their index was up over 4%, 4.2%. This was largely because Japanese stocks are incredibly oversold. This is a strong bounce from oversold conditions, as well as excitement around tech company earnings. Japanese stock market is heavily compromised of tech stocks, and with tech reporting this week, there is excitement about the possibility of them beating earnings. Going on to the next, we have cryptos and commodities. So Bitcoin up 6% and Ethereum up over 14%. Crypto's actually been performing very well these last couple weeks. They're still largely down for the year, about 50-60% down, but they're experiencing a bounce from oversold conditions. This is Bitcoin and Ethereum have been on the gain for the last few weeks, especially Ethereum. Commodities, we have gold, which is up over 1%, silver, which is just slightly down, and oil, which is down about 3.75%. This is the second consecutive week that oil has decreased, pretty significantly too, which is good news for the consumer because that means that gas prices should come down, which would increase consumer spending. The next thing to go over is the different factors that are affecting the markets right now here in the United States and around the world. First of all, earnings season. Right now, earnings season is in full swing. So far, banks have reported their earnings, which have largely topped expectations with a few exceptions. And this week is arguably the most important as big tech is gearing up for their reports. And how technology performs will be very indicative of how the market will react in the short term. With tightening of worldwide monetary policy, the US federal interest rate, currently at 1.75%, expected to rise again this week with another Fed meeting taking place this Wednesday. However, the market has generally reacted positively to the recent rate hikes because they've been viewed as a means of cooling inflation. Generally, rising interest rates is bad for the market, but that is a lever that governments can pull in order to bring down inflation. And currently, investors are more afraid of inflation, and that is why they've reacted so positively to these. But we'll see what happens this week. There's been a decrease in energy prices. As I said, this is the second consecutive week of lower oil prices, mainly due to an increase in supply. Another thing affecting the markets right now is government regulation. The Asian stock market's been performing very well, mainly due to the Chinese stock market reform and promise of financial stability in order to avoid over-exaggerated or manipulated downswings in the market. What the Shanghai Composite is doing is promising that there will not be any manipulated or overdrawn downturns, in that the swings will be regulated and protected by the government. Another important thing affecting the markets is corporate guidance, and this goes hand in hand with earnings season. It's important to look at what companies are reporting on their earnings, but it's even more important to look at what they expect going forward. And that is because capital markets are forward-looking, and even if a company does report good earnings from the last quarter, they need to have strong guidance going forward, and that is what will show true economic health. So this week with big tech, the most important thing is to look ahead. How are these big tech companies projecting their business will operate over the next quarter, even the next year through all these inflationary times? So some things that happened this last week. Number one of the biggest things is that big tech started reporting their earnings. We had Netflix and Tesla, which both reported their quarterly earnings, and both of them beat their estimates by quite a significant margin. Um, by beating these estimates, this boosted the bull case that recession fears are overblown and that consumer spending is still healthy. This also fueled a tech-driven stock market rally. This is why the Nasdaq performed so well this last week, because we're seeing that consumers are still spending money on tech, on big tech, even through this inflationary period. However, on the flip side of this, Snapchat did report their earnings this last week as well. Very weak earnings, and they also gave bad guidance, issuing a warning of slowdown in online advertising spending. And this actually caused Google or Alphabet, Facebook, and Pinterest to drop over fears that because of the tough economic condition that markets are in right now, that they are having to cut back on their online advertising, which would be bad for um, those other advertising groups such as Google and Facebook. Another important thing that happened this last week is that the Federal Reserve signaled their intent of raising interest rates another 0.75% at this upcoming meeting. Um, However, this was the second strongest market rally of the year. This was a very good week, especially for big tech. And this is largely because investors are becoming more confident in the markets. The VIX, which tracks the fear in the market, fell again. This is the fourth consecutive week, fell from 25 to 23. The third consecutive week. And this shows that there's optimism and confidence that is being returned to the markets. And then some things to look for this next week is just what's happening in earnings season, the results of these earnings. There's over 3,000 companies worldwide that are reporting their earnings this week. However, some of the big ones are some of the FANG stocks or the big tech stocks. The ones that are reporting are Microsoft, Alphabet, and Visa on Tuesday. We have Meta or Facebook on Wednesday, and Apple and Amazon on Thursday. These are some of the largest companies in the world, and their quarterly earnings historically have shaped the direction of the markets. So it will be very important to see how these other big tech companies have performed, whether they also beat expectations like Netflix and Tesla, or whether they're the exceptions. Another important thing to see is whether the volatility index does continue to decline for a fourth week. If it continues to decline, this will signal that the confidence people have in the market isn't only temporary, but will actually lead into a long-term rally. The most important thing besides earnings to look for this week is the Federal Reserve meeting. This is happening on Wednesday, where the Federal Reserve is expected to raise the interest rates another 0.75%, which will bring it up to 2.5%, which is an aggressive interest rate in order to fight inflation. Afterwards, Fed Chair Powell will speak, and his commentary has historically moved the market significantly, so that will be an important event to look for. Some reports that are important. This Tuesday, we have the Consumer Confidence Index, Thursday, the jobless claims, and Friday, the most important report, the PCE, or the Personal Consumption Expenditures Inflation Data and Consumer Spending Report. So the PCE, or the Personal Consumption Expenditures, this tracks inflation on a consumer level, but it excludes oil, gas, and food prices. This is viewed as one of the more important inflation trackers, and the most important by the Fed, because this tracks the underlying inflationary trends in the market. Inflation has continued to increase month on month, so the expectations aren't too great for this month, but if there is a downturn in the PCE and if inflation does seem to have peaked, that would be very good news for the markets going forward and could continue to fuel this rally. And then lastly, just some commentary. I just want to go over a different topic each week that's important about investing. Today I wanted to talk about one of my one of the topics I'm more passionate about, which is the importance of dollar cost averaging. So dollar cost averaging, or DCA, it's the process of breaking up a lump sum investment into smaller equivalent portions, and then investing those equivalent portions on a set schedule over a large period of time. So essentially, the way to think of it is, say you have like $1,000 to invest. You could throw the $1,000 in all at once, or you could break up that $1,000 into, 10 groups of $100. And if you do that, and if you break it up and you do 100, let's say every week for 10 weeks, and then you still invest the full $1,000, but because you averaged it out over a period, you own some of the stock when it's high, you own some of the stock when it's low, and you own all of it in between. And because of this, now your position in that stock is the historical average over that period. And now all the day-to-day volatility, all of the short-term trends won't affect your holding in that stock because you own an average over a longer period of time. A way to look at that here is this chart here with Netflix. So as you can tell, Netflix absolutely took off starting in 2017, where it shot all the way from only about 100 in 2017 all the way up to almost 800, just barely, just about a year ago. And this is a huge gain. However, as you can tell, the beginning of this year was horrible for Netflix, and it's since dropped from about 700 all the way down below 200. So it's down about 80% this year. So to apply this to dollar cost averaging, if you had that $1,000 and you put all of it in the beginning of 2022, you would be down 80% right now. You would have bought it at its peak and it would have been down and you would have lost 80% of your money. However, if you took that sum of money, the $1,000, and you broke it up into 10 equal portions and invested one portion, so 10% each year for 10 years, you would still be in a gain position. In fact, you'd have almost triple your money because you own money. I mean, you own some stock from when it was very low, you own some stock from when it was very high, and you own it everywhere in between. And because of that, you now have a historical average. And regardless of huge drop offs that happened this year, regardless of huge gains that happened in the year prior, you are more likely to overcome short term volatility. One of my most favorite quotes. It's no one can time the markets. Time in the market is always better than timing the market. The market is generally rational and it does perform well over the long term. However, in the short term, there are crazy crashes and fluctuations, and the best thing to do is to invest consistently and patiently and wait. Don't try to time the markets, or else you could end up buying into a stock right before a huge crash, like in Netflix. Just patient and consistent investing using dollar cost averaging will help you get through inflationary times. It will help you get through stock market crashes, and it will give you the best performance in the long run. Um, Thank you again for tuning in this week. Unfortunately, I'm actually going to be out of town for a couple weeks, but when I get back in a few weeks, I'll be back to my updates each week. And yeah, I'll have a lot to talk about when I get back. But thank you so much for listening, and I'll talk to you then.